fairly neutral policy from the Monetary Policy Committee. No change in rates, no change in stance, slight upward revision in the inflation forecast for the year, and no change in the growth forecast for the year. That's the short take on what happened at the Monetary Policy Committee meeting, which ended on Wednesday. But the longer story is what was happening behind the scenes. Now, behind the scenes, it looks like the MPC is a lot more concerned about inflation now. They are talking about inflation settling in a band of 4.3 to 4.7% in the second half of the year. In October, inflation was at about 3.6%. They say that already food and fuel prices have hardened, and that impacts household budgets the most. They say that inflation expectations have also firmed up. Upside risk to inflation could come in from global commodity prices, also volatility in global markets, which could have a bearing on currency and imported inflation, and most importantly, perhaps from the fiscal side. On the fiscal front, they talk about farm loan waivers, rollback on excise duty on petroleum products, and cuts in GST rates on a number of items, all of which could lead to fiscal slippage, which in turn would have implications for inflation. So inflation concern seems very much front and center for the MPC. On growth, now they haven't changed their growth forecast of 6.7%, but I think there is a subtle acknowledgement there that reaching that 6.7 will be still a tall order, because you need to be well above 7 for Q3 and Q4 to make that 6.7% number. They talk about some positives on the growth front, like credit growth has picked up, the fact that companies are being able to raise capital from equity markets, also that you could see bank balance sheets getting de-stressed if the resolution process moves along quickly. All of that would aid growth over the coming quarters, but they also acknowledge that downside could come in from segments like agriculture, where there has already been weakness seen in the second quarter. Noting that weakness in growth, perhaps they kept in the phrase output gap in their policy stance, where they said that they maintained a neutral stance, keep taking note of the output gap. I get a feeling that if growth were to negatively surprise in Q3 and in Q4, maybe they will need to use that as an excuse to perhaps cut rates one more time. That's on monetary policy. A quick word of a very important comment coming in from Viral Acharya, the Deputy Governor in charge of monetary policy. He said that yes, liquidity conditions are tighter, but we still remain in surplus mode. They expect mild surplus to continue to the end of this fiscal year, and neutrality to be achieved only at the start of the next fiscal year. They also said they will continue to use all tools, including open market operations, to either infuse liquidity or suck out liquidity as required. Final comment, and perhaps the most interesting one, on bank recapitalization. The RBI Governor Urjit Patel very strongly said that this is not going to be just a recap package. This is going to be a recap and reform package. We are talking about the 2.11 lakh crore recapitalization plan that the government has approved. He said that banks will need to become slim and trim, and if required, shed non-core assets, manage their balance sheets better in order to be able to make a case to get government capital. Important comment, that one, from Urjit Patel.